Run-up so far in the past 15 days has not been bad at all. Aaron Smith of Superfund Financial joins in to talk about what their tactical call has been. Aaron, morning. First, how we are approaching equities before we break that up into little blocks, and what your call is from here.
Well, certainly, Mitali, we think it's a little bit too early to be long in equities. This rally that we've seen since March 6th could be short-lived. As we go into earnings season in the United States, we expect to see almost catastrophic earnings coming out, such that the market conditions could easily retrace and test the lows again in the next couple months.
Would you be trying out any short positions, Aaron, after such a good rally, or would that be dangerous, you think?
It's not a question of if it's dangerous or not. What we'll do is we'll wait until the technicals are very, very clear. So we're not going to make new short positions, or we're not going to make new long positions until, from a technical standpoint, there's a clear trend, and all the technical indicators that we follow will give us a clear direction in the market. So we're happy to also to sit in cash and wait for a clear trend to develop in equities. At the same time, we're trading interest rates, Forex, agricultural markets, as well as commodities, which aren't going to have any correlation to the overall equity market. I think one thing that investors could look at right now is where to put their money. I think equity markets are probably not the best place to look over the next 2 to 3 years.
How have you read how the dollar has moved in the last 1 month, the period where equities have rallied, and how commodities have moved versus the dollar? What kind of trades can you suss out in these two asset classes?
Well, the trade in commodities and the trade in dollar is very clear. First of all, with dollar, this is the time to start going short. We think that this is really the beginning of the end for the U.S. dollar. When the Treasury came out and said, when Tim Geithner said that they're going to start buying Treasuries with up to $1 trillion, that was a clear signal that it's the beginning of the end for the U.S. dollar. Conversely, look at commodities, especially oil, what we think of as the black gold, as well as agricultural markets, are very, very cheap at these levels. One could make the argument that equities are cheap at these levels too, but the big difference is that commodities going out 2 to 3 years will certainly have a value that should be higher than where it is today. You can't actually say that about any paper stock out there. So we would be much more comfortable looking at commodity markets than looking at long-only stock positions at this point.
So are you long crude, Aaron, then? And what kind of target would you work with?
Certainly, crude oil is very, very attractive at these levels. We think that maybe it's too early to say that it's in a clear uptrend. However, we think over the next 2 to 3 years, oil could easily double in value. And along with that, that's going to take natural gas as well as some other commodity markets in the same directions.
What's making you the most cautious on this equity rally? Is it just the U.S. earnings, as you talked about? Or are you sensing that some of the money that's been chasing equity markets this past, about 3 weeks might be pulling out now, booking profits?
Yeah, well, look, I mean, over the past 1 to 2 months, we've been looking for the equity rally, and now it's here, and now I think it could easily retrace from these levels. What we're most cautious about is not the equity market, but the fact that we're looking for inflation to come back in a big and horrific way, because the United States government, through the Treasury, through the Fed, through FDIC, has spent over $12.8 trillion in bailout and stimulus packages. The equity market in the U.S. is only $9.5 trillion. So you have this just huge amount of spending, and that has increased the money supply by such a huge extent that we expect to see inflation, and in some weaker economies, even hyperinflation. That's why the only strategy we think that'll be able to weather that storm is a trend-following strategy.
Is the trend in gold still moving up?
Certainly, it's come back off its highs. I think at 880 in U.S. dollar terms, gold looks relatively cheap. But gold is still relatively close to its highs in most other currencies. So, in the long run, gold is going to have volatility, but it's going to hold its purchasing power, and that's the most important thing. You don't buy gold to make an enormous amount of money. You buy gold simply to protect your purchasing power. It's a much better alternative to a cash position, whereas a diversified managed futures fund will be a much better alternative to holding equities at this point.
Okay, if you had to create a simple long-short strategy right now, simple, not a complicated one as you may be working with, what's the best long and the best short in your book?
Well, first of all, you have to have a lot of diversification in a long-short strategy for it to be successful. So in a managed futures strategy, you trade in 130 different markets. So we have exposure to equities, indices, interest rates, currencies, soft commodities, energies, and metals. If I had to choose, certainly from a technical standpoint, we'd be long in energies, we would be short in equities, we would be short bonds and long interest rates, as we are going into this market conditions today.
Aaron Smith, good talking to you as always. Thanks very much for stopping by today. That's Superfund Financial. They've been one of the biggest or best return generators, globally speaking, in a very difficult economic environment.